Hello and welcome to the Deep Dive. If you're looking for the clearest, most insightful breakdown of earnings calls, well, you've come to the right place.
That's the goal.
Today, we're cutting through the noise of Illumina's second quarter 2025 results, the genomics giant everyone's watching.
Yep.
Our mission, to arm you with the critical knowledge and maybe some surprising aha moments you need to feel truly well-informed without getting lost in all the jargon.
Absolutely. We're going to unpack what really drove their performance this quarter, what management is signaling for the rest of the year, and crucially, what that means for the broader life sciences landscape.
Okay.
Get ready for some insights that might just surprise you.
Right, let's start with the hard numbers. Because even when you think you've got the full picture from the headlines, there are always, crucial details hiding just beneath the surface.
Always.
For Q2, Illumina delivered a non-GAAP EPS of $1.19. Now, non-GAAP, just quickly, often excludes certain one-off items, right? Gives a clearer view of core operations.
Exactly. Core profitability. And that $1.19 significantly beat the $1.03 analyst estimate, like by a full 16%.
Wow, okay. And GAAP EPS.
That came in at $1.49, so that includes everything.
Got it. And the top line, revenue.
Revenue reached $1.059 billion, so just slightly ahead of estimates, which were around $1.05 billion.
Okay, so a beat, but barely.
Right, and it did represent a 3% year-over-year decline, so still down compared to last year. Yet despite that decline, the team showcased pretty strong profitability. Non-GAAP operating margin was 23.8%, which is a solid 160 basis point improvement year-over-year. That's 1.6 percentage points better.
That's not insignificant. And what about cash flow?
Free cash flow was robust, $204 million, with $234 million flowing from operations.
Okay.
And they kept buying back shares too, about 4.5 million shares for $380 million under their repurchase program.
So spending cash there, what did the CEO say drove the results?
Jacob Thaysen, yeah, he was clear. A ramp in X-series consumables, those are the materials their big sequencing machines use, right?
Right, the recurring revenue part.
Exactly. And strong clinical demand. Those were the primary forces behind results that actually came in above their own guidance.
Ah, so they beat their own expectations too.
Yeah. So on the surface, strong execution. But like you said, there's this disconnect. Why did the market react with, skepticism when management seemed pretty happy?
Let's dig into that. What about the bigger picture? You mentioned the overall revenue decline.
Right, but that masks some important nuances. If you exclude Greater China, the decline was actually more modest, only 2% on a constant currency basis.
So stripping out currency effects and China.
Yeah. China itself brought in $63 million in revenue. Now, that was slightly ahead of their expectations, even though it was still a $12 million drop compared to last year.
So China's still a drag year over year, but maybe not quite as bad as feared this quarter?
Something like that. It's complex, and China's a big piece of the puzzle, obviously.
What really jumps out here is this tale of two segments idea. Sequencing consumables overall, $740 million, were kind of flat year over year. But up about 6% sequentially, so from Q1.
Right.
But then you see high throughput consumables, especially for their NovaSeq X, the big machines. Those saw impressive sequential growth, over 10%.
Yeah, that's the key number.
What's driving that specific growth when the overall consumables picture is just flat year over year?
That NovaSeq X growth points directly to the clinical segment. That's the major bright spot right now. It's really absorbing the transition to their newer platforms.
Okay.
This clinical segment now accounts for roughly 60% of total sequencing consumables.
60% already? Wow.
Yeah, it's showing remarkable resilience in critical areas like comprehensive genomic profiling for cancer.
Right, like TSO 500.
Exactly. And minimal residual disease detection, MRD, monitoring after therapy. And NIPT, non-invasive prenatal testing.
Okay, so those healthcare applications are really carrying the load.
They really are. The shift is clearly gaining momentum.
That's a crucial distinction. But is that shift enough? Or is it maybe hiding weakness elsewhere? I mean, what about the research market?
That's the critical question, isn't it? The U.S. research environment, well, it remains constrained. NIH funding uncertainty is still a big cloud.
National Institutes of Health, yeah.
And that's led some labs to delay projects, maybe hold off on hiring. And that directly impacts instrument sales, which were down 18% year over year, only $96 million. That really reflects those tight academic budgets.
18% down on instruments, that hurts.
It does. And it's interesting, even with the restrictions on exporting certain high-end instruments to China, they've still seen some resilience in consumables purchases there.
So people are still using the machines they have, even if new sales are restricted.
Seems like it. It speaks to the underlying demand for the core tech,
Meanwhile, there's the MiSeq Plus, the smaller machine.
Yeah, the low throughput one. That's actually a real bright spot. Over 500 instruments placed since it launched late last year.
This sounds pretty good.
Customers are apparently praising its faster turnaround times, ease of use, especially for labs maybe just getting into next-gen sequencing.
Kind of like a gateway drug to genomics.
Maybe. Bringing in new users, definitely.
Okay, and you mentioned margin expansion earlier. How did they manage that with revenue down?
Right, that 1.6 percentage point improvement in operating margin, that was primarily due to cost reduction initiatives. They found over $100 million in annualized OpEx savings.
So cutting costs worked.
Yeah, strong operational discipline, even with those revenue headwinds from the research side. And they framed it as, focused reductions tied to their strategy, not just slashing everywhere.
Okay, so given all these moving parts, clinical strength, research weakness, cost cuts, what's the outlook for the rest of 2025?
Well, management's still cautious about the U.S. research funding situation. That hasn't gone away. But surprisingly, they raised their full-year guidance.
Raised it, even with the revenue dip.
Yep. They now anticipate a constant currency revenue decline in the range of minus 2.5% to minus 0.5%.
Okay, so still a decline, but less of one than before. What was the old range?
Prior was minus 3% to minus 1%. So definitely an improvement in the outlook there.
That is a notable shift.
Yeah.
What about profitability?
Also lifted, non-GAAP operating margin outlook is now 22 to 22.5%. And they raised non-GAAP EPS to $4.45 to $4.55.
Okay, where did that EPS bump come from?
It's a mix. About 10 cents from new tax legislation allowing R&D deductibility, which helps everyone.
No.
Another 10 cents came from better than expected China performance, like we talked about.
Right.
And the rest is basically from favorable foreign exchange rates and those ongoing operational efficiencies, cost savings.
Got it. So a combination of factors lifting the forecast. What about strategy? Any big moves?
Yeah, they confirmed the definitive agreement to acquire SomaLogic for $350 million.
SomaLogic, right. Proteomics.
Exactly, the study of proteins. They're framing this deal as a bolt-on acquisition to expand into proteomics and, importantly, layer on high-margin SaaS-style reagent pull-through.
Okay, SaaS-style reagent pull-through. Unpack that a bit.
Basically aiming for a recurring revenue model. The idea is their software and data insights drive continuous demand for the high-margin consumables, the reagents. So it's not just about selling the instrument once.
Moving beyond just selling boxes.
Right. They call it a software and content flywheel. It's a pretty interesting strategic pivot.
Towards multi-omics.
Indeed. It aligns perfectly with their multi-year vision to become an integrated multi-omics platform. Studying genomics, proteomics, other omes together for a fuller picture.
Makes sense.
They've also had key product launches like TruSight Oncology 500 version 2 and Dragon 4.4, their analysis software, plus an FDA 510K filing for TSO comprehensive.
That's a regulatory step for clinical use, right?
Exactly. And they've got an R&D day planned for December to detail their long-read sequencing product roadmap. So lots of potential catalysts coming up.
Okay. Did they address competition during the Q&A? That's always a hot topic.
They did. Management reiterated that clinical segment strength will be the main growth driver going forward. They expect that NovaSeq X transition to keep pushing volume, aiming for 75% of high-throughput volume to be on the X platform by year-end.
75%, wow. Aggressive target.
It is. On competition, they acknowledge that faster turnaround times exist in some niche markets, but they emphasized their focus is on the highest quality insights at the lowest end-to-end cost.
Quality and total cost, not just speed.
Right. And they sounded pretty confident in their superior cost structure if a pricing war were ever to happen. That was a strong statement.
Okay. So solid results, raised guidance, strategic moves, but then the market reaction.
Yeah, here's where it gets really interesting. Despite all that, the reaction was, muted to cautious. The stock actually dropped 3.6% after hours.
It dropped after raising guidance.
Yep. And options activity was wild leading up to the call. Put call volume spiked over 5 times the average. Traders were definitely bracing for some kind of volatility.
So why the disconnect? Why the skepticism?
Well, this divergence really highlights that tension we talked about. Is Illumina successfully pivoting to clinical growth, or is the market still worried about it being a cyclical research tools company?
Still focused on the headwinds.
Exactly. Those lingering concerns aren't just noise. Investors are focused on the year-over-year revenue contraction, even if it beat estimates slightly. And the ongoing geopolitical risks like the China export ban.
How much did that China ban affect them?
It impacts roughly 7% of their sales, according to them. So not huge, but not trivial either.
And the stock's recent performance?
It's been a roller coaster, a big rebound, up over 32% in the last 3 months.
Okay.
But still down over 16% year over year. So it depends on your time frame. The market's basically weighing this accelerating clinical and multi-omics adoption against that capital spending restraint in academia and these near-term uncertainties around China and NIH budgets.
A real tug of war.
Pretty much.
So the strategic story is this shift to an integrated multi-omics platform with more recurring revenue. This quarter showed some early signs, right? Margin gains, clinical strength.
Definitely showed traction. But it's still a tightrope walk between spending on innovation like SomaLogic and R&D and dealing with flat overall revenue growth right now.
How deftly they manage that balancing act, that's going to be key.
Absolutely. That will determine if this recent rebound can turn into something more sustained.
Okay. Now, given this complex story, the good operational execution, the strategic vision, but this persistent market skepticism, it kind of begs the question, if we were, spitballing ideas like a hedge fund committee.
The fun part.
How might we try to play this? And that brings us, of course, to our This Is Not Financial Advice segment.
Okay, disclaimer noted. For this scenario, I'm thinking a paired trade with a long duration tilt.
Paired trade, okay. Long what, short what?
We go long Illumina, maybe look to add on any further weakness. The thesis is that the market is sort of overly discounting this successful pivot to clinical.
You think the clinical story isn't fully priced in?
I think so. And the stickiness of those high throughput consumables, plus the potential accretion from SomaLogic layering proteomics into their ecosystem, that shift to the software and content flywheel, that's a potential multi-year re-rating catalyst the market isn't fully appreciating yet, in my view.
Interesting. Okay, so long Illumina. What's the other side? How do you fund it?
We fund that long by going short a pure play academic research tool supplier, someone with really high exposure to NIH funding.
Oh, betting against the weak spot they identified.
Exactly. The earnings call clearly highlighted that continued U.S. research funding uncertainty, the constrained academic budgets, even with that recent R&D tax news. That research segment, Illumina expects it to decline 15% this year.
Okay.
And those headwinds could easily persist into 2026. So this setup lets us capture Illumina's potential clinical and multi-omics upside.
While hedging.
Right, while hedging against that persistent weakness in the research funding environment. It's essentially a bet on the diversification of demand within the life sciences space. Illumina diversifying away from pure research while the short target is still heavily exposed.
Makes sense. A bet on the pivot, hedged against the old market.
That's the idea.
All right, that's a wrap on our deep dive into Illumina's Q2 earnings. We saw, strong operational beats, a raised outlook, that bold strategic play into multi-omics with SomaLogic.
Definitely some positive execution points.
But remember, the market isn't always quick to reward, right? Still seems focused on those geopolitical and funding uncertainties.
Yeah, the path ahead involves navigating that clinical transition really carefully, managing the China situation, and crucially, delivering on those new product pipelines and that whole multi-omics vision.
It's a complex story.
But a fascinating one to watch unfold in the coming quarters, for sure.
Well, we hope this deep dive has given you a clearer picture and maybe some valuable insights. What stood out to you from this earnings call? We always love hearing your thoughts.
Yeah, let us know.
Until next time, stay well informed.